Affirm, Afterpay, and Klarna. You may have heard of these names, right? They're all fintech companies that offer buy now, pay later, or what's called BNPL services to customers. But what has happened over the last 10 months is that all of these companies in this BNPL sector have suffered a lot. Affirm shed 85% of its market value since 2021. Klarna, on the other hand, had to raise a round at a valuation of 6.5 billion compared to its previous round valuation of 46 billion. That's a massive reduction in valuation. Blue-eyed BNPL companies where every investor wanted to invest and get a slice of it is now facing a significant down round and a fall in valuation. So what has changed since the last year? This is precisely what we are going to be discussing in this video. But before we get to that, just letting you know that we have a cool offer that we're running for all our YouTube viewers, and I'll offer more details on it later in the video. So let us first start by understanding what BNPL actually is. Buy now, pay later is basically a credit product that enables buyers to purchase something by paying for it in installments instead of paying 100% of it when you're purchasing that product. The buyer, the merchant where you're buying the product, like for example a website, an e-commerce website, and the BNPL company are all involved in this transaction, and it's useful for all of these parties that are involved. With the help of buy now, pay later, buyers can now afford the product which otherwise they would not have been able to buy because it's too expensive in one go. They don't have to defer their purchase, which is good for the merchant as well, right? The website on which you're purchasing the product. The merchant is also happy because the user buys higher value products or products that they would not have bought otherwise, right? And so because of that, the overall sale value of the website and the conversion increases for the merchant. And lastly, the BNPL company gets fees from the merchant for helping convert the customer, and they can also earn interest for longer term loans that they end up giving to the customer. So all in all, this is a win-win scenario for everyone that's involved in the transaction. But you might say that this is similar to credit cards, right? Well, the answer is not necessarily. Let's understand this with an example. Assume that you buy $3,000 worth of goods online through a buy now, pay later service for 3 months installment. But that means that you're supposed to pay $1,000 to the BNPL company from this month onwards for the next 3 months. Now, these companies may or may not levy interest immediately, depending on the product that they offer. Most BNPL companies will charge interest if the installment duration is longer than typically 3 months, or if you default on the scheduled payment. When installments are opted for, these are usually considered as loans by banking authorities. And so that's where there is a difference between BNPL and credit cards. BNPL actually serves as a loan because you're paying in installments. When you're paying by credit cards, you actually have the opportunity to pay the entire amount without interest, but within a specific period. Typically that's a month, right? You have to pay 100% within a month when the credit card bill comes. You can also opt for installments, but that's not a default option that credit cards provide. Another difference is that credit cards are not available to everyone easily because you have strict credit checks, while the BNPL option is available to a much wider base because it's a typical checkout option on an e-commerce website. The limits for BNPL also tend to be much lower than that for credit cards. Alright, so next up, is there actually a market for buy now, pay later across the world? But if we go by the numbers, the opportunity for BNPL as a product is actually massive. For context, BNPL accounted for 3% or 160 billion in the global e-commerce payments industry in 2021. On the other hand, credit cards, which BNPL is similar to, right, accounted for 21% or 1 trillion in the global e-commerce payment industry. So there's a lot of scope for growth for BNPL. The reason why this option has become so popular is that it's not just enabling payments, it actually helps the merchants or the websites where the sale is happening increase their conversion rates, and merchants love this. Over 1 trillion was spent by US merchants alone in marketing and customer acquisition costs. Imagine if BNPL convinces merchants that they can get better conversion rates and make more sales via enabling this option, then they'll actually divert some of this 1 trillion marketing spend towards fees paid to BNPL companies like Affirm. And these companies can earn some of the massive amounts merchants are spending on the marketing budgets, right? So they can earn a lot more because they help increase conversion rates. So the next section is to understand whether BNPL companies will be able to recover from this downturn. To understand that, we need to first go deeper into how a BNPL business works. And we'll use the US listed company Affirm to show you how the business model is structured. Affirm is one of the largest BNPL players in the world with more than 13 million users on the platform and more than 200,000 merchants as of June 2022. Now, Affirm makes money through 5 revenue streams. But before we dive into those revenue streams, here's the special offer that I mentioned earlier in the video. The first 50 people that use the link in our video description and fund their vested account will get a $20 bonus upon funding. This is an offer that's available only on YouTube and is not available anywhere else. Okay, so revenue streams. Cool. So the first revenue stream for Affirm is its merchant network revenue, or what they also call as merchant discount rates. Now, what it basically means is that Affirm earns a fee by helping convert a sale and facilitate sales conversion for the merchants on the websites where they are available. Because Affirm is not charging any interest for a 3-month installment to the buyer, instead, Affirm charges the merchants or the websites, and this revenue stream makes up 35% of Affirm's revenue. The second revenue stream is interest income. Now, interest is charged if the customer opts for an installment option beyond 3 months. If you take the basic option, no interest. But beyond 3 months, you get charged interest, and this stream contributes 40% of Affirm's revenue. The third revenue stream is the sale of loans. Now, Affirm collects all these loans that it has given to customers, and then it sells them to third-party investors who want to buy it and earn interest. Now, they can either lose or make money based on the specifics of the sale and the individual loan, but today this stream contributes 14% of Affirm's revenue. The fourth revenue stream is interchange fees. Basically, Affirm generates about 7% of revenue through this stream. So it's a small stream, and they get this revenue from virtual credit cards. Affirm offers credit cards to its customers, and whenever somebody uses these online-only virtual cards, Affirm earns a small fee from Visa or MasterCard, the card networks that it has partnered with. And the last and the smallest revenue stream for Affirm, which is about 4%, comes from servicing income for helping manage the loan portfolios for the third parties, right? The selling of loans that it's doing, Affirm manages that and charges a small fee for it. BNPL is amazing for merchants. Let's look at some numbers to give you context. As per Shopify, after the deployment of Affirm's BNPL solution, the merchants on its platform witnessed a 50% increase in average order value. That's a massive increase. They also further witnessed 28% less cart abandonment. So once you've put something in your cart, you don't drop off. The Affirm checkout solution has improved cart conversion by 26% and also increased sales for merchants by 20% after they added the BNPL solution. This is the power of what a good BNPL company can do. But does this indicate that Affirm is generating massive revenue for it? On the back of the booming e-commerce industry during COVID, growth for Affirm over the past few years has been excellent. Revenue, user, and merchant, all these 3 main metrics have been growing more than 50% year over year for the past 3 years. The progress has been pretty phenomenal so far. But then the question comes, right? If the growth is so good, why has the stock price fallen so much over the last 10 months? Well, the reason is that stock prices are a reflection of future expectations, right? More than the past. They signify what investors believe in the future, and the future for BNPL companies is a little tricky. The BNPL industry growth depends on 2 factors. One is user spending, and second is the interest rates. Now, you probably know the Fed recently affirmed its plan to increase interest rates multiple times in 2022. Now, quick digression on why the Fed hikes interest rates. The Fed is hiking these interest rates with the aim of basically taming inflation. With the rise in interest rates, the cost of borrowing goes up, and with a lower money supply in the economy, consumers refrain from making larger purchases and stay away from taking loans to buy houses or other big purchases. The idea is that a decrease in consumer demand can help bring down the prices and, as a result, control inflation. The goal of the Fed when it hikes interest rates is to slow down the economic activity, but not so much that it causes a huge recession. Right, so we saw, okay, why is the Fed increasing interest rates? Let's get back to BNPL companies. Rate hikes affect BNPL companies a lot. These rate hikes force consumers to spend less, and hence consumers will use BNPL to a lesser extent, right? Because you would be using BNPL to make purchases that you otherwise would not have. Otherwise, if you had the money, why would you need the solution, right? So this means if that consumers are not purchasing enough, BNPL companies will lose 2 of their main revenue streams, which is interest income and the merchant discount rate, right? The fees that merchants pay these companies. For most BNPL companies, these 2 sources of income will form a majority share of their overall revenue. As we saw earlier, for Affirm, it contributes to 75%, which is the majority of its revenue. Secondly, we saw that Affirm also generates revenue by selling loans to third parties, right? Now, the cost of capital for these BNPL companies is higher than for banks. In a world where interest rates are super low, investors are chasing higher yield and are willing to buy or lend to fintechs at favorable rates, right? But as interest rates keep increasing, which has started happening from 2022, the fintechs like Affirm, which are trying to sell their loans, will find much lesser buyers because investors are getting lesser risky assets or lesser riskier loans from other places. So recently, it was all over the news that Affirm had to cancel its loan sale after one of its purchasers demanded a higher interest rate on the deal. And this will affect Affirm's third largest revenue source, which is the sale of loans. We saw that it was about 14% of their revenue. Given these factors, the stock market or investors feel that BNPL companies will face issues with their business model going forward and that historical growth may not be possible in the coming future. This is the reason why the share prices of these companies have tumbled so much. It will be difficult for these companies to recover in a rising interest rate environment. Once interest rate hikes slow down, inflation is under control and the dust settles, is when these BNPL companies will likely to be able to breathe a sigh of relief. Alright, so that's all we have for today. We do cover fascinating aspects of various businesses in our videos. If you like this video, you will definitely like our video on Costco's business model. Do check it out. And don't forget to like this video and subscribe to Vested for more such analysis of interesting businesses.